So without further ado, let's talk about the Tax Cuts and Jobs Act and kind of get an idea of what all is going on, because what we're going to talk about here is primarily the individual taxpayer issues. Early on we talked about the business items. This time we're just going to talk about what is impacting individuals, what to be looking for the year, what kind of tax planning we need to do before the end of the year, because even though it looks promising, the devil's still in the details. So what happened? Well, in December of last year, we had the Tax Cuts and Jobs Act signed into law. It changed. It is the most sweeping tax change since the 1986 Tax Act. What we did, we reduced taxes by broadening the tax base. In other words, we're involving more people in the taxes, changing how the deductions look, etc. So essentially what you've got, we're going to have winners and losers, and basically you've got to look at your own situation to figure out where you stand. Most of us are going to come out winners, but not everybody. Early on we talked about, or the president said, we're going to have a postcard for filing our taxes. Well, believe it or not, here's the front page of the new 1040. This is page 1. It's about the size of a half a sheet of paper. Fill in your information. Here is page 2, which is the second side of this half sheet of paper. Basically, if you look at it, now we've got 23 lines from the old front page. It used to be about 40-some lines. Now it's shrunk considerably. Does this mean there's a great lot of change? Yes, it does, because now, if you look at by shrinking this, what has happened is the fact that we have 6 forms, 6 schedules that fall behind this that are needed in order to completely fill out the front page of the 1040, which is now only 23 lines. So we did get the new rhetoric of a postcard for filing, but there's some other changes that went with it. Now, let's talk about some of the pieces of the puzzle and how we're going to come out with winners and losers. If you look at the tax rates, they have changed. They've come down for the most part. Of the rates, the 10 and the 35 are the only ones that stayed the same. They became effective for the 2018 filing year. They will be effective until through the 2025 filing year. However, current legislation is being introduced to make many of the changes that the Tax Cuts and Jobs Act brought about, to make those changes permanent. It will be interesting to see how that comes, what the progress is, but right now, that is what some of our legislators would like to do, is make these changes into permanent legislation, not sunset in 2026. Here's a couple of tables looking at tax rate comparisons. If you just really quickly look, under the new Tax Cuts and Jobs Act, we've got some increases so that basically we stay in the lower brackets longer. This is for single filers. The same thing applies to married filing joint. We don't hit the upper end tax brackets now until an increase of $600,000. It used to be $480,000. That was what was planned for 2018. So you can kind of see, yes, we're seeing some benefits. So between the tax rates dropping and also the rate points increasing, most folks are going to come out a little better off. Another thing that's going to help us, standard deduction. Each individual that files a tax return has a standard deduction. Husband and wife, they get a married filing joint standard deduction. Again, if you look at where it was supposed to have been in 2018, we're supposed to be just around $9,700. With the change, singles went to $12,000. Married filing joint, it nearly doubled. It went to $24,000. There was no change in the elderly or blind, the additional exemption for those. So if you look at this thing, basically you have to have $12,000 as a single individual of taxable income, or income before it becomes taxable. So the first $12,000 of your income is not taxable. Married filing joint, the first $24,000. So basically this implies that we still have a 0% bracket up to $12,000 single, up to $24,000 married. filing joint. So the standard deduction, how that applies: if adjusted gross income is $12,000 or less, then you pay no tax as a single. That's a 0% bracket. The same thing for $24,000 for married filing joint. These amounts, that $12,000 to $24,000, gets indexed for inflation annually. So that will continue to rise into the future. One thing that went away, now this thing kind of stings for a lot of us, the personal exemptions. Historically, we've had a personal exemption. In other words, as a filer of a tax return, you were allowed to count yourself. If you provided a care or payment for the care of another, you got another second exemption. Husband and wife filing joint got two exemptions, one for him and one for her. Each child that was in the household that you paid for, dependents, they were also given an exemption. Well, that went away. They are suspended. Not repealed, suspended. Pointing out the difference, repealed means it's done, not to be brought back. Suspended means it's put out for a period of time, not going to be applied, but at the end of the Tax Act, so basically when we start January 1 of 2026, that tax year, personal exemptions will be brought back if there's nothing done in the way of changes from Congress. So right now, if you look at where it was supposed to be, it was supposed to be $41.50. It is completely zeroed out. Depending upon where you're at, your age, number of exemptions that you had experienced in 2017, this may put you over the top. In other words, making it where the 2018 rules are less beneficial. This slide got scrambled a little bit. Sorry about that. But if you got a better off tax-wise, married couple filing joint, the first column of numbers there, the old law, so we got adjusted gross income under the old rules of $100,000. Under the new rules, same, $100,000. The old rules would allow the standard deduction of $13,000. The Tax Cuts and Jobs Act jumped it to $24,000. The personal exemption would have been $8,300 for married filing joint. That's $41.50 each. Under the new rules, zero. So taxable income under the old rules would have been $78,700. Under the new law, $76,000. But by dropping the rate and also expanding where the breakpoints were, under the old law, tax would have been almost $11,000. Now it's going to be almost just under $8,800. So a significant drop for a married couple filing a joint tax return. Now, if you have children under the age of 17, we're still better off. The new tax laws brought in or changed the child tax credit. Now, this tax credit's been around a lot of years. It started out as $1,000 for each qualifying child under 17 years of age. The new law didn't change the age qualification, still 17. So the minute the child goes to age 17 during the tax year, you lose them that year. However, the amount is now $2,000 per child, not $1,000. The phase out, in other words, where it starts going away, has been jumped up to $400,000. So it used to be much lower. So now it stays around for upper end taxpayers. It is now refundable. Used to not be. What refundable means that if I have no tax due, I can get up to $1,400 of qualifying child tax credit paid back to me, even though I don't owe any income tax. If I owe tax, then I get the full benefit of the $2,000. Otherwise, I get $1,400 of it back. Still have to have a Social Security number required for each child. Non-child dependents. This is if you're taking care of a parent. I ended up taking care of and moving my mother or dad into my home and taking care of them, paying more than 50% of their care, cost of living. Then I get to take a child tax credit for them as well. So non-child dependent was increased or added under the new law. Also, if it's a child that can't take care of themselves, even though they're above age 17, you still get to claim them as well. So as long as you provide more than 50% of their support and they're not able to work, you get to claim them under the child tax credit also. So the child tax credit is going to help. But here's what happens if you look at it. Married couple, 2 children. Under the old law, Adjusted gross, 100,000, same thing. Go clear across. Taxable income, 70,400, 76,000. Now from the prior example, the tax before the credit would have been 9608, 8739. The child tax credit now would allow 2,000 for each child, or 4,000 rather. So the tax due went from 77 to 4739. So more than likely, the majority of us will be better off under the new tax law. However, if you have a great amount of itemized deductions, you have some child tax credit that may go away, you're an upper end taxpayer. When I'm saying upper end, you're probably looking at taxable or income in excess of $150,000 reported on the tax return. If those are the cases, that third bullet or the second bullet point is highlighted for you. Visit with your tax advisor. Don't wait till the end of the year. There could be some problems that pop up. I've talked to a lot of different preparers. I've done a lot of different visit with some individuals that have done some calculations. 80% of them say we're better off. Every once in a while there pops up one that says I'm losing out. So be careful, be smart, go check before the end of the year, because the devil is truly in the details. Until you start really looking at your specific situation, you may not know exactly where you're at. Another thing that's kind of biting us under the new laws, a child under the age of 19 or full-time student under the age of 24, they still get to pay income tax at their rates. However, you have to look at, or if it's earned income. If they have unearned income, let's say you have income, a great amount of income coming from stocks in the form of dividends, or if they have interest income, those can possibly put them in the situation where they are going to be subject to what we refer to as the kiddie tax. It's been around since 1986. Basically, what it was brought into was to stop parents or grandparents from shifting money from themselves to minor children, letting them pay the tax at the child's rate. Thought that was a tax shelter. We did away with it. The kiddie tax then forced parents that or children that had an amount of about $2,100 under current rules from portfolio, that's interest, dividends, capital gains, anything that's not earned. Then there's going to be taxed at the parent's rate. Now under the 2017 or 2018 rules, it's at the estate and trust rate, which is even worse. So the kiddie tax, it's probably not going to hit very many. It can hit some. Basically looking at taxable income from unearned sources, that's $2,100. If you look at right now a $20,000 CD paying interest at less than 1%, you're going to have quite a bit of money involved there. But some of our stocks and bonds pay much better, so you've got to look at those. The kiddie tax will come to haunt us at current levels. So taxable income, 0 up to $2,500. It starts at 10%. If they have more than $12,500, they're at the top tax bracket of 37%. So be aware if you have children in that situation. Now here's where the fun comes. Itemized deductions. If you had a large amount of itemized deductions last year, home mortgage interest, unreimbursed employee benefits, or business expenses, etc., well, those have been suspended. Not all itemized deductions were. A lot were. But look at the standard deduction, $24,000, $12,000 single. By doing this, the tax relief from itemizing is greatly reduced. You look at itemizing when the total value of your itemized deductions exceeded that $24,000 married, $12,000 single. Below that, you just took the standard deduction. So if you had a lot of itemized deductions last year, you may really want to revisit where you're at this year. Again, these are suspended, not done away with, so they will be back after January 1 or December 31 of 2025. Some of the changes that did take place, and here's for the upper end taxpayers. State, local, foreign property taxes and state and local income taxes, they capped those. $10,000 married filing joint, $5,000 married filing separate. So if you pay state, local income taxes and your total tax bill is more than $10,000, you can only itemize up to $10,000. Same thing with property taxes, state, local, and foreign. So the cap, $10,000 joint, $5,000 married filing separate. Home mortgage interest. Not a lot of change here, but it did have some impact. Early on, there was some misinformation concerning home equity mortgage. Both of these are still allowed on first home mortgage, so your primary residence. Indebtedness limitations. If your home costs more than $750,000, then you've got some changes that have to be applied. $375,000 married filing separate. So if your home costs more than $750,000, or homes, so you got a vacation home. If you've got home equity interest plus home mortgage interest, total more than $750,000, it's going to have an impact. It's going to reduce your total itemized deductions. Don't expect this from most folks. More of them that were changed, unreimbursed employee expenses. For myself, I do a lot of traveling with Extension. Extension only pays 47 cents. Federal allows 54. If under the old rules, you could take that difference and they're allowed to deduct that on a Form 2106 and report it as unreimbursed expenses, take a deduction for that. Now that is gone. So unreimbursed employee expenses, travel, meals, uniforms, job search items are gone at the present time. If you hire somebody to prepare your taxes, being able to itemize that expense, not allowed. And also got to remember, tax preparation expenses, if you're a farmer, you pay the tax. Only the farm business side doesn't get a deduction either. So tax preparation expenses are gone. Investment fees. You have some monies in various accounts, money market funds, mutual funds, etc. You have investment fees that you've bought stocks, etc. Those fees, those expenses of reinvesting, selling, are no longer deductible. Safe deposit box rental. That expense is no longer deductible. Hobby expenses. If you have a hobby of making quilts and selling those, not a business, a hobby. Anything in excess of what you bring in, those expenses are not allowed as a deduction. If you change jobs and move, your cost of moving from one location to another, changing jobs, unless you are a member of the military, those moving expenses are suspended as well. Something that's going to hit some of our folks in the western side of the state from the fires, others from tornado losses, personal or small fire, home loss of home, etc., theft. Personal property losses due to casualties and thefts for 2018 to the end of 2025 are suspended. So if you lose your home and its contents, unless that home is in a federally declared disaster area, all the loss of your personal items are not allowed as a deduction off of your tax return. There's no casualty loss allowance for those. This is a major hit for folks in the western side of the state. If they lost items that were business related, not a problem. These are personal items. If they were insured, the amount of the insurance doesn't have to be treated as income as long as the loss was greater than that amount. But any loss in excess of income from insurance proceeds, etc., those are suspended. You do not get to take the loss on those. If you have questions on that, if you know extension staff that lost various items due to the fires of this spring, have them call me. This is going to hurt exceptionally hard. Another thing that's changed, charitable contributions. They're not done away with, but charitable contributions, the deduction, is still limited. However, they raised the limit. It used to be 50% of taxable income for certain items. Now it's brought up to 60%, not taxable, adjusted gross income rather. So if you have $100,000 adjusted gross, the limit is now 60. The 40 that's excess carried forward up to 5 years. It used to be that 50,000 would have been what was allowed. So, charitable contributions still allowed for the most part for most items. Now, if you are buying OSU football tickets and part of your cost is a contribution to the university, to the athletic group, that is no longer going to be allowed as a charitable contribution. Those items are gone. So these are to qualified charitable groups, foundations, churches, etc. Here's where the rub comes of watching out for what to do. Underpayment or withholding penalties. Basically, under the new law, we are changing all kinds of issues, and I'll show you where to go to double check to make sure you're withholding enough. But if you had a large amount of itemized deductions in 2017, or your household income is $150,000 or more, you will definitely want to talk to your tax preparer, and you will want to do that soon. You may need to be adjusting the number of W-4 withholding allowances that OSU or whoever your employer is withholding, because it is definitely, and I did this for myself, it's very hard to come up with what is truly going to happen to us. One of the problems is Oklahoma, we don't have any clue, nothing been brought about from Oklahoma in terms of how they're going to react to the new tax law changes. So whatever you have for Oklahoma probably won't change, but you really want to look at where you're at for federal. Here's how the employee or the penalty works. Basically, you have to look at 90% of the current year's tax due. That has to be withheld. Or from a safe harbor point of view, to 100% of last year's, or if you're a high income taxpayer, $150,000 or more, then it needs to be 110%. The new calculator that's out, 2018 withholding calculator, there's the website. This is an IRS calculator. It does help. It's not foolproof, but it does give us an idea of kind of where we stand. So a couple of things in conclusion on this thing. Don't wait till the last minute. Talk to your tax preparer. Avoid surprises. We're still waiting on guidance from IRS, guidance from U.S. Treasury. A lot of us in the tax preparation education business thought, oh, we'll have information out by June 31. So far, guidance from IRS, guidance from U.S. Treasury is very lacking. We're not sure exactly on most of the itemized deductions. We have a good idea of the changes, how they're going to impact us. Some of the charitable contributions we're a little bit fuzzy on, but if it's to a church, foundation, etc., those are still going to be allowed. Donations due to the fire cause, if they were made to the Oklahoma Cattlemen's Foundation, those will be allowed as an itemized deduction. What we don't know is the W-4. One question that came up yesterday, when will we have true guidance on the W-4? Right now, IRS is saying they won't even have the finalized tables out until after January 1 of 2019. So we're flying by the seat of our pants this year. We may get some tax relief, but don't count on it. Never count on penalty or interest relief until you hear from them. So you don't want to get burned expecting and then not getting. And like I said, for the casualty losses, for Oklahoma, right now I don't know of any due to the fires that we've been declared a federally declared disaster area. So those are some of the things to watch out for. This kind of concludes the tax issues. Been watching the text chat. Nothing has popped up. So without further ado, Roger, if you want to kick in to your discussion, away we'll go.